95% of people in this country are probably going to get killed in taxes because we're not being forward-looking or trying to figure out what do we do to actually solve this problem. We've all been kind of conditioned to think that we're going to pay lower taxes or we're going to be in some kind of lower tax bracket in retirement. And most of the time, we're just finding that that's just not the case. A lot of people, they might be in a higher tax bracket. And a lot of times that's because of the uniqueness of how your Social Security is tied into your retirement income tax bracket, how Social Security is taxed, how much pre-tax money an individual might have. So it's very important to kind of be proactive on tax planning just to make sure we're not getting killed in taxes when we are ready to retire. So first, it's important to understand how exactly your money is taxed in the accounts when you take it out. So there's really three different types of buckets. You have IRAs and 401ks, and that's what we would call pre-tax or forever taxed. And what that means is that, those assets that are in those accounts, those are going to be taxed forever. We're getting taxed when we take money out, when somebody inherits that, if a spouse inherits those assets, if you or your spouse passes away, those are going to get taxed upon withdrawal. And at what tax rate you're going to get taxed really is very specific to the individual in that situation. Okay, so you have to be very aware of how the money is taxed when it's coming out. And then you have things like Roth IRAs and Roth 401ks, okay, where that is completely tax-free. Not only is the growth in the interest tax-free on those accounts as it's growing, but it's tax-free when it comes out as well. Okay, it doesn't count towards things like your Social Security. It's not going to count towards how much you're paying in Medicare or pre-65 healthcare premiums. That's a big one. And then we have kind of non-qualified assets. That's kind of our third tax bucket where you're taxed sometimes. That's things like savings accounts and more traditional brokerage accounts where you're only taxed as you're getting dividends and interest and growth. So it's very important to understand how your assets are taxed in retirement. It kind of guides you on exactly what your withdrawal strategy is going to be for during certain periods of your life. One of the biggest, I won't call it a tax trap, but a misconception for people is that it's great just to pay lower taxes for the majority of your life. But what people don't realize is that as you're paying lower taxes, and a lot of times early in life and throughout your accumulation and working years, we're focused on reducing taxes, saving money. But what that's leading to is kind of a tax trap or a tax bomb later on in life. And the big thing for a lot of people is when we get to required minimum distribution age, which is 73 for most individuals today. That's being phased up at certain ages. When you're turning 73 and let's say you have $1 million, $2 million, sometimes I run into people with more than a couple of $1 million in their 401ks, is that you're going to be forced to start drawing money out of that when you're 73 or beyond. And then you're going to be forced to start paying those taxes. And whatever tax bracket that is, or your specific marriage situation, is all going to be determined by the IRS at that point, and you're not in control. Yeah, so we know what taxes are. We know why they're potentially a problem for people. But a lot of times it's like, okay, so we have taxes. We know we can't avoid paying taxes. What do we even do about it? A lot of people, I would say 95% of people just sit back and they're going to let the tax problem happen. 95% of people in this country are probably going to get killed in taxes because we're not being forward-looking or trying to figure out what do we do to actually solve this problem. And right now, we're in a very favorable tax environment. We're in the third lowest tax window in the history of the United States as we sit here in 2025. We do have some changes that are expected to come at the end of the year if they don't decide to extend tax cuts or that doesn't pass through Congress for whatever. We're going back to pre-2016 tax rates, which are not as favorable as they are today. So for the vast majority of our clients, whether you're younger, maybe you're in your 40s, 50s, 60s, people that I even have in my 70s and are already required minimum distribution age, we have to start de-taxing those assets proactively. We have to look at what the rest of this year looks like. We have to look at the next 3, 5, 10, and 15 years and figure out, does it make sense to start to proactively, voluntarily pay taxes on the assets to get them over to a Roth IRA. And for most people in our situation, anyone that's in a 12, a 22, and I would say even a 24% tax bracket, usually the mathematics would make sense that it does make sense to start to get money over to a Roth IRA. And it's usually not too late for that either. Yeah, so taxes, the thing, and I run into this all the time with clients as far as how you're being taxed. Now, I was with some clients in very recent meetings, and yeah, we want to get $2,000 a month. Well, guess what? They're actually, there's two different ways to do that. You're either going to take $2,000 a month, okay, out of the portfolio and receive $1,500 a month in their individual tax situation, or they were going to have to draw about $2,600 a month to receive $2,000 a month after the taxes were paid. And what that does, it actually takes the withdrawal amount for the net amount that you want to see, right? We want to receive $2,000 a month. Well, if you look at $2,000 a month on a portfolio, that might be a 4% withdrawal rate, okay? But now when I add those taxes back in there and say, hey, we want to receive $2,000, so we actually have to take $2,600 out of that account every single month. That's increasing that withdrawal rate up to something like 5.5%, maybe even a little bit higher. So you're kind of tiptoeing or towing the line of not maybe being at a safe recommended withdrawal strategy because we have to add the taxes in. That's why it's so important to understand not only how your assets are taxed in retirement, but what can we do to make sure that we're not overpaying in taxes when we get to that point. The conventional wisdom when you're talking to maybe an accountant or a tax preparer or your CPA is that we're so focused on paying as low of taxes as we can right now. So a lot of people want to take money from the resources that have already been taxed. And I mean like their savings accounts, their brokerage accounts that have already been taxed. But a lot of times when you're looking forward at tax planning, it does make sense to start to draw down some of the taxable assets and possibly do something like a Roth conversion, because we've run into a lot of different situations where people are just kicking that tax can down the road, and now it bumps all of their income into a very, very high tax bracket, and they're being forced to pay more on their Medicare premiums, and all of their Social Security is now being taxed at a very high rate. And then you run into what someone would call the widow's tax. And I run into this quite a bit, unfortunately, but it impacts women typically more than men because women are living longer and typically they're surviving their spouses. And when you have a lot of pre-tax assets, well, you're paying single taxpayer rates at that point. So we run into all the time where people are living on less income, but they're paying more taxes because they're hitting that widow's tax, that tax trap more or less. So when we're working with individuals that don't have proactive tax planning, there's no doubt that there's inefficiencies and they are going to overpay in taxes. I could think of several instances where I have clients that have a lot of capital gains sitting on their balance sheet, and they probably could have gotten those capital gains out tax-free with a little bit of proactive tax planning, right? Maybe we take a little bit less from the IRA in certain years to trigger some of those situations where we can get capital gains out tax-free, or vice versa. Maybe there's a year that it doesn't make sense to trigger capital gains and it makes sense to draw from the IRAs. There's just a lot of different moving parts when you're looking at tax planning that a lot of people are missing the boat on because, again, we're just not getting qualified tax advice with most of our investment management. So if you don't feel that you're getting proactive, qualified tax planning advice, I would encourage everybody to try to get a second opinion, maybe a third opinion on what you might be able to do to save taxes for you and your family. It's a very important piece of holistic financial planning, and most planners and advisors are missing the boat on it. And a lot of them just aren't allowed to talk about it, right? Some of the bigger firms, they might not be allowed to actually do tax planning for individuals. And it's so important, and I think it's the big area that a lot of people that we run into are missing the boat on. So we would encourage you to come in, get a third opinion. We'll put together a tax plan for you and make sure that you're on the right track.